somewhere. Right now, someone is watching. Stock prices, waiting for the perfect moment to invest. They've been waiting 6 months, and every day they wait, they're losing money. Here's a question. If you could pick the best day to invest the exact moment the market is at its lowest, you do it right. Of course you would. Everyone would. The problem, nobody can. Not you, not me, not the highly paid fund managers with Bloomberg terminals and PhDs in economics. Almost nobody gets it right consistently. And the people who think they usually end up worse off than if they'd done nothing clever at all. In this video, I'm going to show you why timing the market is one of the most tempting and most expensive mistakes in investing. What it actually costs people in real money, and what the boring, unsexy alternative is that quietly builds wealth instead. No charts you need a degree to read. No jargon. Just the honest truth about why smart people keep getting this wrong. Let's start with what we're even talking about. Timing the market means trying to buy investments when prices are low and sell when they're high. Sounds completely logical, right? Buy cheap, sell expensive. That's just good sense. The issue is that to do it successfully, you need to be right twice. You need to know when the market is at its lowest, so you can buy, and you need to know when it's at its peak, so you can sell. And you need to do that consistently, not just once. That's not investing. That's predicting the future. And nobody can do that reliably. Here's where it gets really interesting. A study by Putnam Investments looked at what happened to a £10,000 investment in the stock market over 15 years. If you stayed invested the whole time, through crashes, through volatility, through all of it, your £10,000 grew to around £29,000. Not bad. But here's what happened. If you tried to be clever, if you missed just the 10 best days in the market, over those 15 years, 10 days out of roughly 3,750, your return dropped to around £15,000. Missed the 20 best days. You're barely above where you started. The best days in the market often come right after the worst ones. So the people who panic, pull their money out during a crash, and wait for things to calm down before reinvesting, they miss the recovery. And the recovery is where the money is made. Think about that for a second. 10 days out of 15 years, and missing them cuts your returns in half. So if timing the market doesn't work, why does everyone keep trying? Because it feels like it should work. The logic is airtight in your head. Prices are high right now. Surely I should wait for them to drop. The news is bad. Surely now is a terrible time to invest. And honestly, it's not just ordinary people. Professional fund managers, people paid enormous amounts of money to do exactly this, fail to beat the market consistently. In fact, studies show that around 80 to 90% of actively managed funds underperform a simple index fund over the long term. 80 to 90%? These are people with research teams, real-time data, decades of experience, and they still can't reliably do what everyone at a dinner party thinks they can do by watching the news. There's even a name for the gap between what professional investors return and what the market returns. It's called the performance gap, and it mostly exists because of one thing: trying to be clever when clever isn't needed. Okay, so if timing the market is a trap, what should you actually do? 2 words: time in the market. Not timing the market, time in the market. The longer your money is invested, the more it benefits from compound growth, and the less any single crash actually matters. The strategy most wealth builders actually use is called pound cost averaging. And it sounds technical, but it's genuinely simple. You invest a fixed amount every month, say £100 or £200, regardless of what the market is doing. When prices are high, your £100 buys fewer units. When prices are low, it buys more. Over time, it averages out. You stop trying to guess and just let consistency do the work. No watching stock prices. No waiting for the right moment. No anxiety every time the FTSE drops and someone on the news starts using the word crisis. You just invest regularly. Hold for the long term and let compound growth do the heavy lifting. Let's put numbers on it. Pound 200 a month into a stocks and shares, ESA. Invested consistently over 20 years at an average return of 7%. More than double because you stopped trying to be clever and just stayed consistent. The biggest mistake people make is waiting for certainty that never comes. I'll invest when the market settles down. The market never fully settles down. That's not how markets work. Volatility is on to sign something S, broken. It S, just the market, doing what it always does. The second mistake is confusing short-term noise with long-term trends. A bad week, a bad month, even a bad year in a 20 or 30-year investing journey. Those are tiny blips. The people who zoom out and stay put almost always come out ahead of the people who kept reacting. And the third, doing nothing because the options feel overwhelming. Opening a stocks and shares ESA on Vanguard or InvestEngine takes about 15 minutes. You don't need to pick individual stocks. A simple global index fund and a monthly direct debit is genuinely all most people need. Here's what to do if you want to stop overthinking this and just start. Step 1. Accept that you can't time the market. Not because you're not smart enough, but because nobody is. Let that pressure go. Step 2. Open a stocks and shares. ESA, Vanguard, InvestEngine, and Moneybox are all beginner-friendly. You can start with as little as £25 to £50 a month. Step 3. Pick a simple global index fund. Something like a FTSE All-World Fund gives you exposure to thousands of companies across the globe. No stock picking required. Step 4. Set up a monthly direct debit. Automate it. The less you think about it, the less tempted you'll be to interfere with it. Step 5. Leave it alone. Seriously, check it once a quarter if you want, but stop watching it daily. Time in the market is the strategy. Let it work. So here's the bottom line. Trying to time the market feels smart. It feels like due diligence, like you're being careful. But the data is pretty clear. Almost everyone who tries it ends up with less than the person who just invested consistently and did untouch it. The boring strategy wins. Consistent investing, low cost, index funds, and time. That's it. That's the whole thing. You don't need to be a genius. You just need to start, and then stay patient. If this helped, hit subscribe. I post straightforward personal finance videos just like this every week. And drop a comment below. Have you ever waited for the right moment to invest? Let me know how that went. I promise I won't judge. See you in the next one.